In this video, we are going to discuss about gap. Now, gap is a very important concept that we have learned. There's a falling window is also a gap. That means there is a candle and the next day price gaps down. So there is a gap between the two candles and the price is also coming down. So the price opens much lower. That's a falling window. In rising window, the opposite thing happens. That means the price today is a candle, tomorrow the opening price is higher, much higher than today's close. Then we look at the breakaway gap, in which there is a consolidation or a range which is broken by a gap. That means the breakout happens with a gap, and when a breakout happens with a gap, then that gap is not filled and it may make a big candle from there. So that is what a breakaway gap is. That means we are breaking a resistance, an important support or important resistance level by a gap, and then sustaining it with the same direction, making a move in the same direction. So breakaway gaps are usually a good breakout in which the price or a trend is usually established. That means there is support and there is a resistance. So after a breakaway gap, if another day means the next day the price again gaps up or gaps down, as the case may be, what I'm trying to say is that the first day there is a breakaway gap and the second day is another gap in the same direction, then that gap is called a runaway gap. That means the price is running away from the point of breakout. So from the point of breakout, the price breaks away with a gap, makes a candle, and the next day on the same direction it again gaps up, and that means the price is rallying on that direction. It could be up or it could be down, but it is rallying in that direction. So that means it is running away. So that's why it is called the runaway gap. Now this breakaway gap is usually followed by runaway gap, and then runaway gap is followed by exhaustion gap. That means maybe 2, 3 or 4 days consecutively the price is opening gap up and sustaining that gap and continues to goes up or go down if it is on the downside. So there is the gap is never filled, but one day it will happen that the price opens with a gap and then fills the gap. That means on the upside the price opens with a gap up and then fills the gap. That means the price comes down. In case of lower side, the price opens with a gap down and then goes up and fills the gap. That means the buyer or the seller on that direction is exhausted and is showing some exhaustion. That means the price that was rallying has now come to a halt. It may not reverse immediately, but it will at least go in a consolidation or take a breath before continuing the direction. So that is showing some exhaustion in the move. So the breakaway gap comes. After that, if consecutively it opens with gap, then it is called a runaway gap, and after 3 or 4 such days, one day will come when the price will open with a gap and then the gap is filled. Now this is called exhaustion gap, as it shows some exhaustion in that direction. The next is common gap. Now common gap is more common, as you can see every day. Today at what price the market closed, tomorrow there will be some difference in that price between open of tomorrow and close of today. So previous close and the next day open, there is a difference. That is a gap, but this common gap is more dangerous than a breakaway, runaway or exhaustion gap. This is because this gap is not directly visible on the chart. In chart, if we see one after the other, then we can get some idea about it. Now this chart is of India Bulls Housing Finance and it's a daily chart. You can find most gaps in daily. Now in weekly and monthly you may not find gaps that clear, but in daily chart you can get a clear view of the gap, or you can spot the gap very easily. Now you can see the price from there, it was kind of consolidating after a fall, and this is a resistance and this is support, and it is kind of making a range here. We can see a range. Now you can see that there is a range which was consolidating for some time, and this is a support on the lower side, and on the upper side we find a resistance. So this is a support and this is the resistance. So the next day the price opens with a gap down. That means the support level is broken in the opening itself with a gap, creating a gap in between or a window in between. What we see, a falling window. Now this window will act as resistance in the coming future. So if it goes up and even if it fills the gap, then also chances are that it will fall from there. Most of the time it falls from there. So you can see that now if we zoom it out, you can see that this was a shorting opportunity. Now the next day, the previous day the close and next day open, it creates a gap, and that happens as open equals to high. This is the first thing, that is a breakaway gap. And this breakaway gap, why it happens a breakaway? Because it is breaking away an important consolidation level or important resistance level with a gap. So we call it a breakaway gap. So that is a good shorting opportunity, and with the open equals to high, it creates a more sentiment on the downside. Now this breakaway gap is usually on the side, the move after the breakaway gap is usually on the side of the trend. Now why that happens? Because people are trapped. All the people, all the buyers who are trapped there will start to square off their position in losses, and because of this the ripple effect will be created and margin calls will be called, and then the fall is usually sharper. So whenever, and even if it is not that great, still if there is a breakaway gap like this one, then the price usually makes a big move on that direction. So if we move forward from this, you can find another gap on this day, and you can see the price was going up and it was making another range. There was a consolidation, and on this day you can see the price makes a gap down, and then you can see the price fills the gap, but there was a clear breakdown with a gap. Now these gaps, it can be formed on the side of the trend, or it can be formed on the opposite side of the trend. Now in two ways the gap can form, like if it is an uptrend, then we can find an uptrend, and in the uptrend we can find a gap on the upside, or in the downtrend we can find a gap on the downside, and so on. Now you can see that here a range has been formed. Now there is a range, and on this day the range is broken, or important support is broken with a gap down, creating a window in between or a gap in between. So you can see this was an important consolidation, as 4 or 5 days it spent there, and this candle broke the low with a gap, and this gap that is created is a breakaway gap. So the price breaks away an important resistance. Now whenever price breaks this important resistance with a gap, the sentiment becomes bearish, and the next day the price again gaps down. Now with the breakout gap, when the price on the second day also it gaps down, then we find what is called a runaway gap. That means the price is running away. It has given a breakdown, and after breaking it is now running away. So on this day, it may create a window, creating a breakaway gap, breaking the support with a gap, and on the next day, what it does, it creates another big gap. So if you have shorted on the breakaway gap, then the runaway gaps will usually give you huge profits if you are holding on to it, because the price falls very sharply in these cases, as we can see here. And that's a 25 point, in a stock of 200 rupees, it's a 25 point gap down. So that's a huge profit and a huge move. So the gaps are very powerful, as you can see, and you can see the next day the price opens gap down, but it goes up and fills the gap. So there is no more gap like the previous. You can see there is a gap like a window in previous two candles, but here there is no window. The price comes down and closes lower, but it first goes up. That means it is showing some exhaustion. Like, in what way the price was running, it is showing some exhaustion. Like in previous two candle, it didn't give a chance. It gaps down and then falls, gaps down and then falls, but here it goes up. That means the price is in exhaustion. And the next day it again gaps down, but you can see here also these gaps are prominent and this will act as resistances. So after the day of exhaustion, it again made a gap down, but the price from down it came up. That is because these are acting as resistance and it is showing some exhaustion. Now here you can see one common gap, that there is a big candle and the next day price gaps up. You can see that on this day it made a small body candle, and the next day the price opens gap down but not below the low of this candle. That means it is slightly gap down from previous day close to today's open. It is a gap down. So that is a common gap, and you can see that here on these days, these 3 days, there were some buyer who bought here and expecting the price to go up. Buyers bought here expecting the price to go up, and all these buyers are trapped here. So when the price opens gap down, so all these buyers who have bought on these days are trapped. That is why the price usually goes down, because they want exit from their position in losses, and they will start to square off in the loss as the price comes down, and all the buyers who are trapped here will slow and steady book their losses. That is why common gap is very important if it is happening in the opposite direction. Like the price is going up, it's an uptrend, but then suddenly the price opens gap down. So the common gap is in the opposite direction of the trend. In those cases, it falls down, and if the price is going up and it opens gap up, then there will not be much impact. But if the price is going up, it's an uptrend, but the gap is on the downside, if it gaps down with the common gap that is in the opposite direction, then the power is more and it's very much impactful. You can see on this candle, the next day when the common gap happened, you can see that if you do a forward testing, then 9 out of 10 times or 8 out of 10 times at least this will work, and the price makes a big move on that direction. Here in this case you can see the price opens gap down and the price fell sharply. That means the price was holding its level on the upside, and when gap down happened, people panicked and sold off. That's why you can see that this candle, it went in the direction in which direction gap down happened. It is opposite of the side of the trend, or opposite on the side of the strength, I must say. So from there it fell down and it's a huge fall. So looking at this opening, if you can sense the common gap and you can short with some confirmation, then with small stop loss you can trap all these buyers. And this open equals to high was a confirmation that the price is going down. So the open equals to high and a common gap, this combined together is a lethal weapon. So after watching this video, you should not be trapped in these scenarios. Like, you can understand that when a gap happened, a common gap happened, you can understand that you are trapped. So you should exit immediately, and you can 5 minute or 15 minute. If you see there is open equals to high and then there is a common gap. So the first thing is open equals to high, and the second thing is that there is a common gap. So when there is a common gap and that should be in the opposite direction, then you know that this is a very powerful weapon, a very powerful pattern. So if you are spotting this, then you will make a good profit. But if you are trapped here, that means you are the one who has bought and is in the trap. So in that cases, what you will do is you will exit as soon as you can, maybe in cost or maybe in some minor losses, but you should book your loss right there. Now this is a gap up scenario. You can see that the price makes a gap up, creating a window, and when the next day the price falls, it takes support there. That means the window is acting now as a support, as you can see. Now you can see that in this level it was slowly going up, creating a range, and then on this day what it did, it just broke away. So it just created a breakaway gap, and then you can see the next day the price almost stayed right there. It opened gap, but not that huge gap. That means the strength is not that huge. You know, in previous examples that we saw, that after gap down, again a sharp gap down with a big gap down happened and the price fell in the direction. But here on the next day, the price doesn't make a big gap up. So that shows that the move may not be huge. So these things will come with experience, and as the more the chart you see, the more clear you will get on this. So gaps are very powerful tool, and if you use it wisely, it can make a huge profit out of your trading.